The markets are in full swing with worries for possible escalation of the Israeli conflict easing somewhat, yet still present. On the monetary front, we note that a number of high-ranked policymakers from various central banks are scheduled to make statements throughout the week and may sway the market's mood. As for financial releases, we note the release on Monday of Japan's corporate goods prices for October. On Tuesday, we get UK's employment data for September, Sweden's CPI rates for October, the Eurozone's revised GDP rate for Q3, Germany's self indicators for November, and we highlight the US CPI rates for October. On Wednesday, we make a start with Japan's revised GDP rate for Q3, China's industrial output rate for October, UK CPI rates for the same month, Eurozone's industrial output for September, the US PPI rates and retail sales both for October, and Canada's September manufacturing sales for October. On Thursday, we note the release of Japan's trade data and Australia's employment data, both for October, the weekly US initial jobless claims figure, the US November Philly Fed index, and October's industrial production. On Friday, we get UK's retail sales, Eurozone's final electricity rates, and Canada's producer prices, all being for October. The USD seems about to end the week in the greens, and on the monetary front, we know that Fed Chairman Powell, along with other Fed policymakers, expressed some uncertainty on whether the Fed's tightening is enough to combat inflationary pressures in the US economy. The statements were perceived as leaning on the hawkish side by the market, yet the market's expectations that the bank has reached its terminal rate seem to remain present, and any further hawkish comments may contradict them and provide support for the USD. On a political level, we note that the possibility of a US government shutdown looms, and in the next week we may see discussions for the issue arising and affecting the US dollar. On a deeper fundamental level, market worries for a slowdown of the US economy tend to persist to some degree, and on a macroeconomic level, we note that October's US employment report showed some cracks in the US employment market and tended to solidify the market's expectations for the Fed to remain on hold. The next big test for the greenback is expected to be the release of the US CPI rates for the same month, and a possible failure of the rates to slow down may enhance hawkish tendencies within the Fed and thus support the US dollar. The pound is to end the week lower than the US dollar, higher than the JPY and the euro. On a fundamental level, we still see the cost of living crisis as possibly the main issue for the UK economy, albeit market worries for a possible recession to also remain. Such worries tend to ease by the release of GDP rates for Q3, which showed that the UK economy avoided a contraction. It should be noted that at a monetary level, the cumulative tightening of BOE's monetary policy so far has had a negative effect on growth, as was expected. Furthermore, the consecutive rate hikes seem to have eased inflationary pressures, yet the CPI rate remains still very high, which in turn tends to place more pressure on the BOE to act. For the time being, we note that the market's expectations are for BOE to remain on hold and proceed with a rate cut in Q3 24, underscoring that the bank may have reached its terminal rate. Nevertheless, inflationary pressures are still present, and hence we highlight the release of the UK CPI rates for October on Wednesday, and should rates not slow down further, we may see the pressure on BOE intensifying. The JPY is about to end another week low against the US dollar, the euro and GBP in a sign of broader weakness. We still view BOJ's ultra-loose monetary policy as the main factor behind JPY's weakening, and should be noted that despite the bank signaling that the rise of wages is a prerequisite for an exit from the current settings, BOJ Governor Weta stated such a scenario may not be necessary. Yet even that was not able to reverse the market sentiment that now requires more concrete steps on behalf of the bank. We remain worried for the weakening of the JPY, as despite getting some respite after the release of the US employment report for October that allowed JPY to gain some points against the US dollar, USD JPY has restarted its upward movement and is in a zone that may cause Japan to intervene in the market to JPY support. On a macroeconomic level, we still are worried about the growth of the Japanese economy, given also its strong manufacturing orientation, and hence highlight the release of the revised GDP rate for Q3 next Wednesday, and a possible slowdown or even a contraction of the growth rate may intensify such worries and weigh on the JPY. The common currency seems to have remained relatively unchanged against the US dollar, implying some resilience, yet given that it strengthened against the JPY and GBP. On a monetary level, we maintain the view that ECB is to maintain its current interest rate level for a prolonged period, practically something that is also anticipated from the market. We know that the bank seems convinced that the current level of rates could bring inflation back down to its 2% year-on-year target, and any talks for a possible rate cut were dismissed as being premature by ECB policymakers. We expect that ECB stance, given the surrounding circumstances at the time, seem to provide some support for the common currency. In the coming week, we expect the release of Eurozone's final HIC period for October to confirm the remarkable slowdown reported in the preliminary release, implying that ECB's cumulative monetary policy tightening is working. On the other hand, the revised GDP rate for Q3 is expected to verify the contraction of Eurozone's economy on a quarterly level, which would be a sign that Eurozone's economy is struggling and could intensify Euro traders' worries for the economic outlook of the zone. AUD is about to end the week lower against the US dollar, and RBA's dovish hike may have been key in AUD's weakening. RBA, in its interest rate decision, decided to hike rates by 25 basis points, yet in Governor Bullock's statement refrained from locking in further rate hikes. The governor, in her statement, recognized that inflation is still too high and that it remains persistent, possibly with slower easing than initially expected, yet also stated that the bank practically remains data dependent, thus weakening AUD. On a fundamental level, we tend to have some worries for China's data released last week, as despite an acceleration of the import growth rate, which would imply more exports of Australian raw materials to China, the trade surplus narrowed substantially and the export growth rate slowed down. Furthermore, China showed deflationary rates for October, both on a consumer as well as on a producer level, in another sign of the headwinds faced by the Chinese economy in its efforts to recover. Further such signs for the Chinese economy could weigh on the Aussie, given the close Sino-Australian economic ties. Hence, in the coming week, we highlight the release of China's industrial output. The loonie ended the week lower against the US dollar, and the drop of oil prices for the week may have been a key factor behind it. It should be noted that oil prices were driven lower as the US oil market seems to have presented slack, with US oil inventories rising. There were extensive worries for the demand side of the commodity, especially from China, given its problems in growing its economy, and market worries for the Israeli conflict seem to have eased given the intensification of calls for a ceasefire and humanitarian aid to Gaza. We expect that should oil prices continue to fall, we may see the CAD slipping further, given that Canada is a major oil producing country. On a deeper fundamental level, we note that the CAD failed to gain from the market sentiment and view that a more risk-oriented approach by the market may support the commodity currency in the coming week. On a macroeconomic level, we note that September's trade data were quite favorable, as the trade surplus widened, yet the wide contraction of the building permits growth rate also for September tended to create some worries. In the coming week, we have a number of medium impact financial releases which could affect the CAD's direction.
Everyone, my name is Emily and today we're going to talk about inflation. In a market economy, prices for goods and services can always change. Some prices rise while some other prices fall. Inflation occurs when there is a general increase in the prices of goods and services. It means you can buy less for €1 today than you could yesterday. In other words, inflation decreases the value of the currency over time. When measuring inflation, all goods and services that households consume are taken into account, including everyday items such as food and petrol, durable goods such as clothing, PCs, and washing machines, and services such as hairdressing, insurance, and rented housing. All these goods and services that households consume during the year are represented by a basket of items. Every item in this basket has a price, which can change over time. The annual rate of inflation is the price of the total basket in a particular month compared with its price in the same month 1 year earlier. In a healthy economy, annual inflation is usually in the range of 2 percentage points, which is what economists consider a signal of pricing stability. And there can be positive effects of inflation when it's within range. For instance, it can increase spending and thus stimulate demand and productivity when the economy is slowing down and needs a boost. On the contrary, when inflation begins to exceed wage growth, it can be a warning sign of a struggling economy as consumers' purchasing power will decline. Inflation impacts consumers most directly, but businesses can also experience it. As mentioned, when inflation rises too much and it is higher than wage growth, then households or consumers lose purchasing power as the prices of items they buy, such as food and petrol, increase. Companies also can lose purchasing power and see their margins decline when prices increase for raw materials used in production, such as coal and crude oil, flour, and steel. To respond to the rise in prices, companies tend to raise the prices of their products or services to offset inflation. This means that the products that consumers will buy will become more expensive. Statistical agencies measure inflation by first establishing the current value of a basket of various goods and services consumed by households, referred to as a price index. When calculating the rate of inflation over time, agencies compare the value of the index over one period to another, such as month to month, which gives a monthly rate of inflation, or year to year, which gives an annual rate of inflation. For example, in the United States, the Bureau of Labor Statistics publishes its Consumer Price Index, which measures the cost of items that consumers buy out of pocket. The CPI is broken down by regions and is reported for the country as a whole. Another measure of the prices that people living in the United States or those buying on their behalf pay for goods and services is the Personal Consumption Expenditures Price Index, which captures inflation across a wide range of consumer expenses and reflects changes in consumer behavior. Thank you so much for watching us.
Okay, I guess we'll just go ahead and get started now. So, first things first, as per usual, a disclaimer. So, products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today's webinar on support and resistance. So here's our agenda for today. Firstly, we'll be looking at using swings for support and resistance levels, followed by looking at where exactly you should place your starting points. And then we'll be going into pullbacks and overlaps and combining these two in order to use these with Fibonacci as well. Okay, let's get started. So firstly, we'll go into how exactly you can use swings for support and resistance levels. So support and resistance levels in trading basically refer to prices at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, chart patterns, so on and so forth. Additionally, you can also look at previous highs and lows of the asset, as well as volume data to identify potential levels of support and resistance. So this is basically what we will be focusing on today. And it's important to note that these levels are not absolute and can change over time. So continuous monitoring is necessary. So I've added an image here for you to see how exactly we can use swing highs and lows as resistance and support levels, but we will go through it more in depth in the next few slides. So take note of how there are clear peaks and troughs in the market structure, and these areas can be used as your support and resistance levels. Okay, so firstly, let's look at an example of insignificant swings. So these are bad points to use for Fibonacci starting and ending points, but they're also not exactly good to be used for resistance and support levels. And I've shown you an example here in the GIF. So you can see that the price movements are really small and there's no significant swing highs or lows. Here's another example. So once again, there aren't really very clear swing highs or lows, and price movement is very small. Okay, and now let's take a look at a correct example of significant swings. So here you can see that there is a clear move up and down with obvious peaks and troughs and clear market movements basically. So in this GIF, that's basically what you are looking for when you are deciding on a chart to analyze on. So people may ask like which time frame do you use, which time frame do you recommend? And it's completely up to you. It depends on what kind of trader you are. So if you're a scalper, of course, a smaller time frame would be better. And if you are a swing trader, a longer time frame would be better. Okay, but still, when deciding which time frames to use, a important consideration is also the clear market structures. So you want to look for something like this, a clear market structure with significant swing highs and swing lows. Okay. Okay. So support and resistance. You can use these levels as take profit and stop loss levels, but you should not use it as an entry if there are no other supporting arguments, such as Fibonacci or other graphical levels to support your analysis. Using a recent swing high or a recent swing low is typically considered a weak level if it's just that level alone. So you can see in this GIF here, oops, in this GIF here, the recent swing high and lows, although they are significant, so you can see them very clearly, but they are not strong levels to use because we don't have additional Fibonacci levels to support them, and we don't have pullback or overlap support levels or multiple swing high or swing low support levels. So I'll show you what exactly I mean by that. So this is typically what you want to look for. So we're looking for multiple swings. So if at least two swing high or swing low levels line up nicely, these are typically much better levels to use. So you should try to find areas where these might line up, and it does not necessarily have to be at the exact same level because these tend to be areas more so than levels. So in this GIF here, you want to see how far you can, you want to see how far back your resistance or support line can go, and it's okay to cut through small wicks since support and resistance levels are usually in areas. Okay, so you can see here we have 4 swing highs that are about the same level, and we want to avoid cutting too many candlesticks, but if you're just cutting the wicks like in this example here, that's perfectly fine. Okay, so now that we know how to identify significant swings and use them as support and resistance levels, what are some things that we can look out for when inputting a support or resistance level? Okay, firstly, picking a starting point. So when picking the starting point of pivot, which is your entry level, support and resistance levels, these are typically your rules that you can follow. Excuse me. So firstly, we want to check if there is a swing high or low, and we've gone through those in the previous slides. We also want to look for pullback or overlap levels. So if you are wondering what exactly those are, I'll get into those in the coming slides. Next, we want to go as far back as possible. So as you saw in the previous slide, I did mention we want to try and pull it back as far as possible without intersecting too many bodies of the candlesticks. So we want to avoid cutting the thick part of the candlestick and just the wick. So just the little sticks on top of the candles, those are perfectly fine. Okay, so the orange thumbs over here represent an okay intersection. They're not preferred, but not exactly wrong. But preferably, we want to look for intersections that are only of the wicks, like over here. Okay, some more examples over here. You can see this thumb, this red thumb is what we want to avoid because it's cutting too many bodies of the candlesticks. So these green thumbs are what you typically want to look out for, where you are just cutting the wicks of the candlesticks. Okay. Okay. Another example here. Similarly, this red highlighted area, it's not preferred because you're cutting too many bodies of candlesticks. Okay, yeah, so the green thumbs, again, just cutting the wicks of the candlesticks. So something like this, would have multiple swing highs. We can just stop the support, or in this case, resistance. We can stop the resistance level just at this green thumb here. And it would already be considered a pretty significant level because we have three swing highs that line up nicely at the same level. Okay, which is important because you can see that price has tested this level many times before. Okay, next let's go into the pullback and overlap. Let me know in the chat if you guys have are aware of what exactly pullback and overlap level is before I show you guys the next slide. Okay, I think, yeah, because I do mention these a couple of times in our previous webinars, but no worries. Let's just go ahead and take a look at these. So firstly, we have pullback. So pullback, from the name suggests, we are expecting price to pull back to a certain level. Okay, so it's basically a strong level of support because it breaks out from a previous resistance level and price is now dropping back to visit it again. So in this case, we're just talking about the pullback support first. So if you take a look at the GIF, this is a pullback resistance. So just ignore that for now. Okay, pullback support is basically the opposite of that, where we are expecting price to retrace back to your support level. Okay, so a pro tip is when a pullback support lines up with a Fibonacci level, it's typically considered to be very powerful. For pullback resistance, these work well when it breaks a significant swing low and then starts pulling back to it. So it's even better, again, if there are multiple Fibonacci levels that are lining up with it. So here in this GIF, we have, okay, ignore the Fibonacci levels first because it is a little bit messy. But maybe I'll just refresh it. Okay, so here is our swing low for reference. Okay, so this is our swing low that we are using as a support level for now. But since price has already broken it and it's dropped below the support level, it's then a resistance instead. Okay, it's a resistance because we are expecting price to reverse off of that level. And that's why we call it a pullback resistance because we are expecting price to retrace back to the level and pull back to it. Okay, it is a little bit confusing, so let me know if you guys have any questions. But now if we talk about the Fibonacci levels. So here we are using a Fibonacci retracement. Okay, and I'm circling the 38.2 because it lines up nicely with my retracement. Once again, I have another retracement. In this case, the 61.8 lines up with my resistance, pullback resistance level. Okay, and now you can see that price really pulled back to our resistance and bounced off of it and headed downwards again. Okay. Okay, maybe I'll just let you guys watch the GIF one more time. So price has broken out of the support level, the swing low support, becoming a pullback resistance. Okay, and now that the resistance lines up with not one but two Fibonacci retracements, it's considered a confluence area. That's why I've highlighted it. Okay, and yeah, you can see price reversing off of the level again. Okay, so confluence areas typically are considered quite important levels because you have multiple Fibonacci levels or moving average levels or whatever that line up with your support and resistance. Okay, so those is basically evidence that price is likely to respect that level again. Okay, so here's an example. Firstly, I have 3 swing highs that line up nicely. Okay, at this area, this red highlighted area. Price breaks out of the resistance area and it moves upwards. Okay, moves upwards, and once it breaks out of this area, it's considered a not Fibonacci, it's considered a pullback support. Okay, um, basically, when you have a resistance, once price cuts or breaks out of the resistance, it's then the opposite. So then it's a support instead. Okay, so then we call it a pullback support because we're expecting it to pull back or retrace back to the level, as you can see from the dotted arrows here. Okay, another example. In this case, we have a pullback resistance. In the beginning, we have 3 swing lows that line up nicely. Okay, so swing low, we would think of a support. Now that price has broken out of the support level, it's then a pullback resistance instead. Okay, so the pullback resistance, we're expecting it to retrace back to that level. Okay, another example here. So we have a significant swing low here over the circled area, and thus it is a possible support level. But now that price has pulled back and it has surpassed the swing low support, it is then a pullback resistance. Okay, so now let's see if price pulls back to this resistance level. And you can see that it actually did. Okay, so price has reached the pullback resistance level just as we expected. And once it reaches and reverses off of it, it will then be called a resistance, overlap resistance level, which is what I'm going to get into in a little bit. Okay, okay. Next we have the overlap support and resistance. So an overlap support occurs when there are prices that touch the line from the top and from the bottom. So the more times that it reacts off of that area, the stronger the level is. So the reason for this is because it means that there are bulls and bears that are respecting that area, and therefore it's an important point to take note of. Okay, so once again, if your overlap area lines up with other elements such as Fibonacci or graphical elements such as your um, moving average or pivot points, for example, it will make it even stronger. So in this GIF, an overlap resistance happens when price touches it from the first point, which is over here, and from the bottom, which is here. Basically, when there is a swing low and a swing high that line up nicely in the same area. That's basically what an overlap level is. Whether or not it is a resistance or a support depends on what the latest, where the latest point touches the line. So if it touches it from the top, it is a support. If it touches it from the bottom, then it's a resistance. Okay, here's an example. So the swing low support becomes a pullback resistance once price breaks the support at this 105.643 level. Okay, so you can see in this GIF how price retraced or pulled back to this resistance level and in fact reversed off of it, making it now an overlap resistance. Okay, so you can see here the minute that price, okay, here in the original image, price broke out of the swing low support. So once it breaks out of the swing low support level, it is then considered a pullback resistance. And once price retraces that level and reverses off of it, then it is a overlap resistance. Okay. Okay, let's move on. So now we're going to combine both pullback and overlap levels. Okay. Excuse me. Okay, so here we have a big swing high resistance level, okay, at the start, and price surpasses this level over here. Okay, so the moment price surpasses this swing high resistance, it now becomes a pullback support instead. Now, price has made a pullback to our pullback support and has bounced off of it perfectly. So once price bounces off of it, it then becomes a overlap support instead. Okay, another example. So we have two swing highs that are lining up. You can see these purple circles here, and we have a swing high resistance from this. So price surpasses this level here, it breaks out of it, and then becomes a pullback support. Number three, point three, price has pulled back to our support and has bounced off of it twice. So the blue circles is where price bounced off of it. So once price bounces off, it now becomes an overlap support. Okay, I think by this time you guys probably have gotten the hang of it. So this is just my last slide, and then we will take a look at some charts. Okay, so once again, combination of pullback and overlap. Firstly, we have a multiple swing low here. Okay, 1, 2 circles here. Point two, pullback resistance. Once price breaks the multiple swing low support, it then becomes a pullback resistance, and then it reverses, pulls back to our resistance, and reverses off of it 3 times here. Okay, so once price breaks out of this overlap resistance, it then becomes a pullback support once again. So every time it crosses the level, it basically switches from a support to a resistance or from a resistance to a support. Okay, and then 0.5, lastly, price has pulled back to our support and reversed off of it. So this level at the 33420, you can tell that it's a very significant level because price is continually retesting it. Okay, so what's important here is that because it's a pretty significant level, you can also expect Fibonacci levels to line up nicely with this level. Okay. Okay, now let me pull out my trading view and then we can take a look at some charts together. Let me know in the chat if there are any specific charts that you would like to see. Okay. Okay, here are my charts. Okay, if there are no specific charts that you guys would like to see, I'll just go ahead and maybe analyze gold first. Okay. Oops. Okay. Okay, so this is an example of a really clear um, price movement. Okay, so we have three swing highs here, and you can see really clearly the peaks here. Okay. Okay. So we have a swing high, multiple swing high resistance here at this level. Okay, and we can see price um reversing off of it. Okay, and this is on our weekly time frame. So we like to look at higher time frames first so that we get an idea of what the general direction of price is on a zoomed out kind of basis, and then we can compare with the lower time frames after. So once again, I'm looking at this on a weekly, daily time frame. Okay, and I can see that we have this decreasing trend line. So I think in our next webinar next week, we will be talking a little bit more about trend lines and trend channels, but I'll just briefly go through what makes um, a valid trend line. Okay, so what makes a valid trend line is if there are at least 3 touches on a trend line. And if it is decreasing, your trend line should be drawn, or rather, if it's a downtrend, your trend line should be drawn like this from the top. Okay, if it is a ascending trend line, then we can draw it like this, so from the bottom. Okay, but of course, this trend line is not valid because I don't have 3 touches on it. But this is basically what you are looking for a ascending trend line. Yeah, so sorry about my throat. The weather is getting cooler, so I'm feeling a bit under weather. Okay, so now let's look at the 4-hour time frame. So we typically like to analyze either on the 4 or 1 hour time frames, and how we decide between the two is like I mentioned earlier, by looking at the chart structure, okay, the price structure. So you can see on our 1 hour time frame, it isn't really nice to analyze on. And the reason for that is because price movement is like pretty small. Okay. It's quite small. But if we look at our 4 hour time frame, you can see that we have much clearer price movements. So that's basically what we look for. Okay, so I'm gonna analyze this on our 4 hour time frame. Okay, let's see. We're gonna start off by identifying the trend. So we can all agree that this is a descending trend line, right? Or rather a downtrend. Now I'm gonna see if I can find any graphical analysis to support that. So I kind of have a descending trend line here. Okay. Now that I've done that, the next step is to go in with support and resistance levels. Okay, here is my my second support, second resistance. My first, okay. I'm gonna see if I can find a closer resistance level. Okay, this level here is my first support. Okay, and then my first resistance, maybe here. And then my second support just here. Okay, so maybe just a recap. So my second resistance, I have a swing high here and a swing low here. So it makes it an overlap level. And then I also have another swing low here. Okay, so I have bulls here and bears, both of these areas respecting my second resistance. So it's a pretty significant level, and that's why I have labeled that. Okay, and my first resistance, I just have a swing high here. Price has kind of broken out of these levels. Okay, so I only have a swing high level here. Okay, and that's the reason why my next step is to go in with Fibonacci levels to try and support these levels a bit more or adjust them and see if I have any better levels to use. Okay, first support is because it's the closest swing low to where price is currently at. Okay, and it also respects a couple of swing highs and lows. Okay. Second support, the reason why I put it there is because we have this swing high here and a couple of swing lows here as well. Okay. Yeah, and it's also basically the closest level to my first support. Okay. Now let's go in with our Fibonacci levels. Okay, so here I'm using a Fibonacci projection. Okay, and for Fibonacci projection, we use these three levels, and we use the tool Fib extension. Okay, that's on TradingView. If you're looking at MT4, I think it's also this symbol, but I don't think it's called an extension, but it basically has 3 points for you to analyze. Okay, and for Fibonacci X projection, just to recap, if you weren't here for our Fibonacci series, we look for a flash. Okay, a flash or like lightning bolt kind of shape. Okay, something like this. Okay, here, even though you can see my 78.6 lines up nicely with my first resistance, this is no longer valid because price has already broken out of the level. Okay, so I'm just going to keep my 100% here. That lines up with my first support. Okay. Mm, okay. Here I can see that this Fibonacci retracement lines up with my 61.8. The 50% is no longer valid because price has already broken out of it. Yeah, so just my 61.8. Okay, and this is a retracement. So for retracement, we use the 5 levels that I was using earlier, 23.6, 30.2, 50%, 17.6, and 61.8. Okay, I think that's all the levels that we have here. Okay, I think that's all the levels we have for Fibonacci. So the next step is to go in um with some indicators, and my favorite indicators to use are the Ichimoku and the MACD. For Ichimoku, I like to just look at the cloud, which is just the plots here. Okay, because if you look at all of the lines, which you can as well, but it is a little bit messy. Okay, So I like to just look at the clouds because at one glance, you can see exactly what the signals are. So if price is moving below the Ichimoku cloud like it is here, price is moving below the Ichimoku cloud, so it is a bearish signal. Okay, so it supports our analysis that price is likely going to continue to drop from the first support down to the second support. Okay, um, but over here, our MACD is giving us a bit of a bullish signal. You can see from the green here. Okay, and the reason for that actually could be because, as I mentioned earlier, our first support is here. Okay, and it's a pretty significant level with the swing highs, the swing lows. So it's an overlap support, and we can expect price to come back and retest this level, which is doing now, as you can see. And on top of that, we also have this 100% Fibonacci projection. Okay, that has not been um it's not been surpassed yet. So we're still seeing price test this level, but because of the downtrend from this descending trend line, we saw on the daily, the weekly time frames that price is still pretty bearish on those levels, on those time frames as well. So we can expect price to continue to drop towards the second support because of all the downward pressure. Okay, but for now, it is still testing our first support. Maybe we can use another indicator. Okay, let me know in the chat what indicators you guys like to use. Okay, I like to use these three. Okay, on our RSI, we're also seeing a decreasing trend line. So it's also supporting our bearish signal here. Okay. Let me know if there are any questions. Oops. Okay. If there are no questions, I think we still have time for one more chart. So if you guys don't have any requests, I'll just go ahead and do maybe the Aussie dollar because we recently saw the RBA releasing a cash rate statement. So let's take a look and see how price affected the charts there. Okay, so same thing, I'm gonna analyze this on a weekly chart. Okay, let's see. Yep, we have a descending trend line on our weekly time frame. Okay, next, if we take a look at our daily time frame, also descending trend line here. Okay, remember the three touches here. Okay, next on our 4-hour time frame. So once again, I'm deciding between 4 or 1 hour, but both of these charts seem to be pretty clear. Maybe I'll just go ahead and analyze this on a 4-hour time frame. Okay. In this case, I don't really have a descending trend line, I think. Yeah. Let's see. Okay, I don't really have a descending trend line here. Okay, but we can definitely see that the trend is downwards. Okay. Now, I'm gonna go in with my support and resistance levels. Okay, this is my first resistance. And my first support maybe just here. And my second support here. Okay, now we'll go in with some Fibonacci levels again. Okay, we don't really have very nice levels here. Okay, my 100% level lines up with my second support. Let me see if my 78. Okay, it lines up, but it's no longer valid because price is already broken out of it. Okay, so just my 100%. Next. Okay, I think my 38 lines up, yep, with my first resistance. Um, okay, my 61.8 also lines up with my second support. Okay, so you can see here I have a confluence area here. Okay, so what I am doing here is I have recognized this Nike tick shape. So it's upside down, but this is the shape that I'm looking at. Okay. Yeah. So for this, we are using the Fibonacci extension tool. So it's the same retracement tool, but instead I'm looking at the 127.2 and 161.8. And I can see that both of these levels line up with my second support. Okay, and I feel like that's one of the reasons why you can see this reversal of the first support here. Okay. Okay, now let's pull out some indicators to support our analysis. Okay, price is moving below the Ichimoku cloud. So it's giving us bearish signals. MACD is also giving us a bearish signal, so we can expect price to continue to drop because of all the downward pressure. Once again, our indicators are also supporting this. Although we are seeing this rebound off of the first support, as I explained earlier, it's likely because of this 127 and also because of the release of the RBA cash rate. Okay, but yeah, there's a lot of downward pressure, so we can likely expect it to continue to drop towards our second support. Okay, confluence areas also tend to have confluence areas also tend to attract price. So we can expect price to reverse off of it, but we are also expecting price to be attracted to this area. Okay, so areas like our second support, where you have the 100% Fibonacci projection, 61.8% Fibonacci projection, and this huge swing low here. So we can expect price to continue to drop here. Okay? Any questions before we go? You have to include the wick in swing high and swing low in putting resistance and support. For Fibonacci, I feel like it's good practice to include it. But for support, swing high and swing low and putting for resistance and support levels, it doesn't really matter because, as I mentioned earlier, it's more so levels, areas rather than levels. So you can see here, even though I didn't include the wick here, right? Okay, let me zoom out. But you can see I actually highlighted this area here because of my Fibonacci levels that line up nicely. So for these support and resistance areas, I am expecting them to be areas more than levels. So yeah, it doesn't really matter for support and resistance levels. Okay, I hope that answers your question. Okay, any other questions? Okay, if there are no other questions, yep, no worries. Thank you guys so much for joining me today. I hope you guys found this helpful. And for part 2, I'll see you guys next week. Thanks, everyone. Have a great rest of your week. Bye.